1,003, 1,004, 1,005. Oh, I didn't see you there. You're probably wondering why I'm hitting the weights. Isn't this supposed to be an investing show? Well, today we're talking barbells. Not that kind of barbell, the kind that could help balance and build your portfolio. So if you're looking for a financial fitness plan that balances growth on one side and defense on the other, you might want to stick around. You're watching Inside Investing. Hello, everyone. Welcome to another edition of Inside Investing, your guide to DIY investing with insights from savvy everyday investors and financial pros. Presented by TD Direct Investing, named Canada's top online broker in 2026 by Money Sense magazine. I'm your host, Caitlin Cormier. We're exploring the barbell strategy in today's show, and we want you to get in on the conversation during our live Q&A session. Submit your questions for Paul using the chat box on Webroker or in the question and comments box on our broadcast platform. And if you're joining us on YouTube, just follow the link in the description. There are plenty of ways to have your say. Joining us is Paul MacDonald, President and Co-Chief Investment Officer of Harvest ETFs. Paul, it's great to have you back with us, and thanks for taking the time.
Caitlin, I am really pumped up to be here.
Yes.
I did practice that.
We've got a barbell pun in already. I love it. Really excited to kind of dive into this conversation. So let's start at the beginning. What is the barbell portfolio, and how can investors strike that balance between offense and defense within their portfolio?
So look, when we think about portfolio construction, you know, the barbell strategy, people often remember it as, barbelling bonds, legging bonds out over a barbell. But when we think about it from the equity side, it's not necessarily one specific strategy as much as it is a concept. And the concept really flows with our view of the world right now, where we really want to make sure that we do have some areas of growth. Growth continues to be an area of the market that is working, but we have to be cognizant that, it doesn't always work. And we want to make sure that we have some defense on the other side. So the plates that one puts on either side of the barbell will vary by person, but the concept of making sure that we have some growth on one side and making sure that we are allocating to some defensive areas, that's really the big picture concept when we talk about barbell equity investing.
Okay. I usually think of a ladder when I think of the bond thing, but yeah, right. Barbell, makes sense. Okay, for sure. So talking about the barbell portfolio, thinking about a more traditional asset allocation, something like a 60-40 portfolio, under current market conditions, why might you want to look at something like the barbell versus that more traditional portfolio?
So a few different reasons, and I think one, jives really with the fixed income market in general, and that traditional 60-40 mix. It worked really well for the 20 years, and I think we have a chart later on that will show worked for about 20 years as interest rates were coming down. It didn't work before that, and it's not working currently. And so we'll talk about fixed income, I'm sure, later on. But when we think about where we're at in the world from an economic standpoint, everybody tells me, oh, stocks are expensive. And I'm like, well, no, they're not really. And growth is working. We have to be cognizant. Things like inflation remain sticky. Sentiment moves up and down. But no question, the policy risks, unless you've been in a basement for a long time, they have continued to remain very high. But the market has moved higher and higher during all of these policy risks, if you will. So growth is still very much an area that we want to be allocating to. But everybody, I don't want to say everybody's been on one side of the barbell in the market. Some of the areas really have not participated or have been doing well. So it's been a very, I don't want to call it bifurcated, but effectively a market where a lot of things haven't been participating while some things have. So we want to make sure, I continue to believe those areas are going to have growth as we move across this cycle. They're not terribly expensive given the growth that we're seeing and continue to expect to occur. But these areas that have been left behind a bit, there's probably some opportunity. And so we want to make sure that we're allocating towards both of those areas. Given this sort of macro backdrop, given the fixed income world environment that we have, We think that having some defensive equities, it's not necessarily a replacement, but we should be considering those areas right now.
Okay, and just to think about the working out side of things, we don't want one muscle that's really big and the rest of them are, not worked out at all.
Yeah, no, we don't want to be Popeye.
No, we don't want to be unbalanced. We want to make sure that, yeah, okay, fair. I think it totally plays into that. So bonds are very close to my heart. Viewers of the show, I'm sure have heard me say this before. They're having a bit of a moment right now. They do have a little bit more attractive yields than they have maybe in the past. So why is it that we exclude them completely from this barbell portfolio?
So for us, we're not bond specialists, and I think for the right people, there is still a need to have fixed income in your portfolio. We have a chart up on the screen that really kind of shows the history of, this is bond yields, but consider bond yields or bond prices, in a similar way, where effectively for, a 25 plus year period from the 90s into the 2000s, we ended up having bonds inversely correlated with stocks. So you had this nice smooth ride, stocks down, bonds up. And we saw that in 2022, I think it was, when actually things, when they become correlated together very quickly. And so people often think, oh, this is temporary, this isn't going to last. There's a whole slew of reasons why rates have continued to move higher. One, geopolitical risk, but the economy in the US is doing very well. So there's inflation from that. There's the transitory inflation, air quote transitory. And so those all cause rates to stay higher. And when we look back in past cycles, on the chart that you see there from really the 60s to the 90s, there was a period, and a very long period, where inflation was a concern, where stock and bond prices were actually moving in the same direction. So you don't get that same type of balance that you perhaps did in previous cycles. I'll ostracize that though. When I think about fixed income, and duration, as it's called. I don't want to go peel back the layer too far, but we really think that fixed income having shorter durations, or specifically target dates, and I think innovation in the ETF landscape, we don't have it at Harvest, but having these target date bond funds where you have a definitive period, especially for retirees, where you need to have certain amounts of capital with a degree of certainty at a specific time, having those target date bonds still do make sense. But that traditional 60-40 mix, where I'm going to have 40% in 7 to 10 year duration, and it's going to do well when markets are pulling back, I think that that's not the type of environment that we've been in or are going to stay in the near to medium term.
Just to clarify, so the target dates, those it's like essentially till 2030 or something like that. There's a specific date that is in mind.
That's right, and so in the past, in the past, institutional investors could access very specific bonds with maturities, and some individual investors could. Now, through the innovation of the target date bond funds, there's a number of companies do them, and so you can actually go out and have the 2030, 2032 bonds, and the 2028 bonds, and that you have a basket of bonds that are expected to mature at that time. So as opposed to taking that continual, if you have a bond fund that has really 10-year duration, in 10 years you still have 10 years of duration. So I think the innovation it makes a lot of sense. Again, it's not in our wheelhouse, and our view would be that 60-40, even in a traditional sense, for those that needed a 60-40, has significantly changed. And the target date might make a sliver of that component, but I don't think that traditional 60-40 balance strategy has as much merit as it did for the 25 years coming into the late 2020s.
And if we look at that chart, so it's kind of interesting. So there was the negative correlation, then there was like the positive, they're moving in the same direction. But then it does look like it kind of goes back in the other way. So which is it just that it's less predictable now? Is that the idea, that there's less predictability, or?
I think less predictability, and we have had a little bit of a moment more recently where there's been some inverse correlation. But I would say when we think about those 30 years when bonds were, and this is bond yields, so I want to be clear, when bond yields are moving with stock prices, bond prices are going inverse. And so, when we think about it from that allocation of, I want to have something that is balancing out stocks up, bond prices down, it seems more like stock prices down, bond prices down has been more the norm recently.
So Paul, is the 60-40 dead?
I don't think dead, but it has morphed. That's for sure. Yeah.
Okay. Yeah, so it's got to take like maybe some different workout, pump up some different.
Well, look at and even when we think about that barbell, perhaps there's different, and people need income from their portfolio. So there's strategies that you can, and I joke about the plates that you can put on either side of the barbell. As opposed to perhaps having that fixed income on your defense, maybe you can find some, areas that have defensive characteristics on the equity side, but monetize the options market and generate some cash flow through option strategies.
Okay, let's flip to the other side of the barbell. Let's talk a little bit about the kind of offensive side. Overvaluation. We're talking all the time about overvaluation in like high growth assets like tech stocks, crypto. Why would we want to put these into our portfolio? Why are we adding these types of investments to the portfolio?
Great question. I had a call with a senior person on Monday, and they said, what do I do? The market's at 30 times earnings, and I kind of went, which market? And so when we actually look at valuations, they're not expensive. Are they a little bit elevated in pockets? And I know we have a valuation chart to show, but when you go back to a market cap, which is our blue line on this chart, that's the S&P forward earnings expectations, and the blue dotted line is the 10-year average. We're a little bit ahead, but it's not like this screaming 1999. And I'll come back to that in a moment. That when I look at the orange line, which is the equal weight, we're actually trading on where 10-year average valuations are. But then when I look at forward estimates on earnings are up 20% this year on the S&P. That's where estimates have increased, and that is a huge increase. And why is that? Well, everybody's like, oh, AI. Well, look, the capital expenditures that are happening within AI are filtering through the entire system. And so it is a huge industrial infrastructure spend that is happening. And that is, when we think about past cycles like this, they are 8 to 10 year cycles. And so we're in year 2 of this capital spend. Now, that doesn't mean, it's risk-free by any means. There's lots of policy risk, but then there's also other exogenous factors that could derail some of the capital expenditures. But we now see almost half of the S&P, their CapEx increases, the money they're spending this year is going to be up 10%. That filters through. And so we're seeing it, perhaps we don't see it as much on the ground here in Canada, but absolutely on the US side, the money is being spent and it is translating into growth. Are we going to have some pockets of pullbacks? Absolutely. And that's hence that barbell strategy. Why, to your point on why add growth, that's plain and simple why we want to add growth, is because the economy is expanding. There's a huge industrial infrastructure spend on tech that's still very early, and we want to make sure we're participating in that. Days like today are a great example. When you have high growth expectations and they don't come in, every quarter it might mean you get a pullback. And so, today we see it on the defensive side of our barbell. That's actually doing really well. And so we want to add to areas that have growth. We're big believers that growth is still a driver in the market, but balance it with some defensive areas.
Okay. Talking the balance, so we're talking about how would an investor know with this strategy how much to allocate to defense, how much to put on the offensive side, and are those kind of moving targets or are they stagnant? Like, is this something that we fix it and forget it, or or is it constantly evolving? What does that look like?
Yeah, really complicated question, because for each person and where they're at in their investment life cycle, that is going to change. And so what types of investments to put, especially on the growth side, I would argue, especially on the defense too, but in particular, what I see with a lot of people is when they say, oh, I'm going to buy some growth, they've got 2 stocks and they're like, that's my growth. And it's, well, that's not how we see the world. We like diversity. We like diversity across, it's not just tech. We want to have exposure to other areas that are what we call cyclical. So benefiting from this expansion of spending. And so think about things like industrials. And so I'm not going to answer the question by answering the question on how much. We have to really take consideration on where we're at, how much risk we can afford to take, what our time horizon is. And that will also dictate the types of investments that we have on the growth side of the ledger in particular. And I would also say just, there's a lot of product out there. How much do I put into each specific one? Really, you have to peel back the layer on what you're actually investing in. So no answer to the exact amount, but you definitely have to have both sides of it.
So let's just say, for example, we have 2 investors. We have an investor who's, just starting out, they're young, they're just putting money away for retirement, versus somebody who's, close to that retirement age, they're looking more towards the income side. How would you, what sort of in a hypothetical situation, what kind of breakdown would you look at?
It's not advice.
I know, of course not, never. No, just sort of give us a bit of an idea, a little bit more of an idea.
Yeah, so look, I think one of the things, somebody that's young that can afford to take on some leverage and understand how that leverage works over time, you're probably going to have a heavier weighting on your growth plates. And that really would make sense that you've got a longer time horizon for investing. You can withstand some ups and downs. I still think 3 to 5 years is a standard time for allocating to equities in general. And so you might look at something like a 75-25. I still think you need to have some areas that have consistent cash flow, things like utilities, some banks, some healthcare companies. Those are important to have within that sort of balancing the barbell, but you're probably a little bit heavier skewed towards areas like industrials and perhaps some small caps, perhaps some emerging markets, and certainly just given what we're seeing on the spend side, a diversified technology exposure is a very key component of that. Not just, and I'm not just talking about NVIDIA and Apple, but I also am a big believer in DeFi. So having some of that unique exposure. That would be for somebody that is perhaps a bit younger, long time horizon, and then somebody that's more on entering the retirement years, cognizant of leverage, keeping leverage more modest if at all, and then you probably are skewing a little bit heavier. I still think you need to have a good allocation into the growth areas. That's what's working. I think covered call strategies, that's what Harvest specializes in for people that are entering into retirement or closer to retirement. The people are like, why would I add growth if I'm a retiree? Well, options are priced off volatility. Volatility is often associated with higher growth. So you can actually generate a lot of cash flow from those strategies. So again, we're adding different plates in depending on where our investment time horizon and what we're looking at. So something like perhaps a 30-40% on the growth side, but a different type of growth. You're looking at maybe something that's got covered calls and options to generate cash flow from it for a retiree, and then 40-50% on kind of those more traditional asset classes or sectors, if you will.
I mean, hopefully we're all planning for a long retirement. So hopefully that 3 to 5 year time frame is not even close to the end of our retirement.
Very much so. Yes.
So it makes sense. The equity piece makes sense. And the other thing I'm taking away from that is when we talk about a barbell, like I traditionally think of, 50 pounds on this, well, with my 1,000-pound weights, we've got 500 on either side. But you're saying maybe it's 700 on one side and 300 on the other. So it doesn't have to necessarily be even. It can be, even though it's a barbell, it doesn't have to.
Absolutely. Doesn't have to balance. It really comes down to the individual. And then also when we start to think about the types of plates that we're putting on, it really does change for the type of investor. Somebody that has small cap exposure, modest leverage, younger, versus somebody that's in the retirement years. You probably want to be looking at something that is a little bit more established, something that has a little bit longer track record, and certainly monetizing the volatility using options is a strategy that has really matured over the past 5 years. And so there's lots of options for retirees to choose on both sides of the ledger with options, but in particular on the growth side.
Okay. And we'll get into the options in a minute here. I want to go into, you've brought us an example here today.
Yep.
Of a barbell portfolio, and you have used Harvest ETFs.
Yep.
To build this, and you have a retiree specifically, which we've kind of been talking about, in mind. So why do you feel, what do you think can you tell us a little bit about this portfolio that you've built essentially?
Sure. When we think about defensive areas of the market, they're typically areas that we look for that are non-cyclical. It does not mean, when I say defense, it doesn't mean it goes up when the market goes down, asterisks, because, today is a great example of this. We look at the market today, tech is pulling back fairly hard. If somebody's watching this in the future, it was Google's earnings. Google's down, Tesla's down 17%. HHL's up 1 and change intraday. And so, we have this dichotomy in the market where, it's, tech and growth is doing well, everything else isn't. And then we get a pullback and all of a sudden, healthcare utilities are performing well. In part, though, as we think about it over a longer cycle, these are areas that typically have a little bit less growth, are typically less cyclical. So, we need to go see the doctor, we need our prescriptions, need our surgeries. No, it doesn't mean they don't go down in recessions because electives are reduced. Similarly, we turn our power on every day. We need that cash flow. To become more sensitive, is there industrial demand in a recession that declines? Yes. But the ride is much smoother. So inside our HHL's largest healthcare ETF in the country, 10 plus years of the same distribution. Our global utilities, similarly. It turns out, though, one of the really interesting dynamics of AI is power demand. And so we need a lot more power. So you're actually, dare I call, utilities and having growth in utilities, less so in the domestic Canadian market than you see what we see in the US and over in Europe. And then we have core Canadian equities. And so dividend factor focused fund. That's kind of our more defensive side. And on our offensive side, our HHIS, 20 really higher growth names. We utilize our single stock ETFs, has a little bit of leverage. We have a non-levered version of that as well. But that's really your higher growth US. I say tech, but we have some names like Lilly, and we have some SoFi and different names like that are in there that are typically, and some of the names in there are typically names that you don't want to buy individually in our view, which, great companies, Palantir, et cetera. You go through some of the crypto related trading companies. Great way to get exposure to that. HHIC 10, large cap Canadian stocks, a little bit higher growth, a little bit of leverage. And then we just recently launched our international. Similarly to HHIS, it has a growth bias that if you were just to buy an international fund, you wouldn't get. So for us, this is a way, and the allocations will vary on the person, but this is a great way to get a fully diversified barbell approach.
Bitcoin, you brought that up, so the idea of crypto. Is there a piece, an area for crypto within this strategy?
So we are big believers in DeFi, decentralized finance, over the cycle. And, Bitcoin, we launched a blockchain fund, I want to say it was 2017 or 18, before we really saw the crypto whole ecosystem mature. And so we're big believers that is going to continue, and Bitcoin has established itself as sort of the default gold standard. So we want exposure to decentralized finance, whether it's through the various trading platforms, and we have funds that do have exposure to this. Everybody's going to be different. A very small allocation into novel assets like Bitcoin. We actually have a strategy that uses options on Bitcoin ETFs, so we're actually monetizing some of this volatility. I think is absolutely an okay area to be. But it's not the shallow end of the pool. It is high risk. Conversely, I also still think traditional areas, and maybe there's been some absorption of Bitcoin away from traditional gold. And so I still think gold also as a real asset falls into a similar area where, a store of value during very challenging environments. I want to make sure that we have some allocation to gold as well.
Okay. We've danced around cover calls a little bit here. We've talked about them. So why do you think that the ETFs using the cover call strategy, obviously you said that's something that Harvest is really focused on. Yep. Why does that make sense on the offensive side, specifically for kind of retirees, rather than focusing on that purely high growth piece?
Yeah, so covered calls are a great way to monetize some of the upside. And we do that on a month-over-month basis. So we launched a suite of ETFs. You can now buy an individual, if you want an individual stock with a covered call strategy. We have some non-levered, some lightly levered. We have that option. We've got 36 different tickers that people can choose if they want to build out their portfolio and they want to build out their barbell with individual stocks. We have that. And so it just really allows investors to monetize some of that cash flow, in particular for people that want to maybe increase their yield on their portfolio without taking on duration or credit risk in the fixed income market. This is a way to do that. That's broad-based. Now, within the growth side of one's portfolio, though, why it makes sense, it's simple math. With the higher growth areas, you get typically more volatility, and I know I mentioned this before, but with higher volatility, that's how options are priced. Mm-hmm. Exactly. And so for taking on that risk, of the higher growth, you are adding that cash flow. So if you're going to have growth exposure, why not monetize some of that cash flow for your cash flow needs? That's kind of our view on it.
Yeah, it's interesting because when I think about the covered calls, we typically focus a lot on the fact that there is a cap, right? That's the piece of it. You get the income, but that comes at a cost to the growth. So I see it on the defensive side, but it's interesting to look at it on the offensive side too. I hear what you're saying about the premiums being higher because they are more volatile and stuff like that, but I just think of that cap. That's the thing that keeps coming out to me is the cap. And if we're looking on the offensive side. That's
right. And you still want to make sure though, in our view, that typically how we run our funds are 33. We can go up on some of our funds to 50% writing, but typically we're 33% across our funds, which means you still have 2/3 of that upside every month. Mm-hmm. And so unequivocally though, I want to make sure everybody is aware, you don't get, double-digit premiums or monthly annualized distribution, so you don't get 15% yield without giving something up. And the trade-off on that is you forego the upside. For us, it's typically on a third, but very clearly, it's foregone upside every month. So you miss out on a third of the upside each month. The trade-off is big premiums.
Right. Yeah. Okay. Very interesting. Okay. So we've talked about a lot of the things that are customizable, a lot of the unique things, how this is kind of taking that traditional portfolio, maybe like amping it up a bit for kind of our more customizable market. What are the downsides of a barbell?
So I think a couple things. When I hear a lot of people talking and they say, oh yeah, no, I've got great growth, on the side of my in my portfolio and it's working really well. I think being overexposed on one side and having too much risk is a negative. And in a pullback in the market, if one is overly exposed on growth, that's going to cause some potential meaningful pullback. The other side though is a lot of people haven't had any growth. And so in those situations, I think adding in this environment, adding some of the growth and making sure that we do have some growth here, because missed out on quite a bit already, and it looks like the market is going to continue to have that growth. The downside is you very much have market-like exposure, and so depending on how you're allocated, you can get some downside. You can mitigate that by having some option premium a little bit. You can mitigate it by perhaps having we talked a little bit about it, by maybe if having some target date bonds so that you have some cash flow if you're a retiree coming in and coming due at times when you need it. in, call it, the next three years. But the downside really is you've got a market-like portfolio, but if you're not exposed to either sides of that barbell, you're either going to miss out on potentially some growth, or if we do get a pullback, something exogenous, meaning something we haven't seen. I mean, we've seen a lot of negatives. I mean, tariffs, wars everywhere around the world, more tariffs, and the market has continued to move higher. So we see those risks, but they're known. So we're more worried about what's unknown, and something comes out of the side that we haven't seen. Having some more defensive areas, I think, to cushion that will help out.
Like a 2020 where nobody saw that coming.
That's correct. Exactly.
You can't price that in. Okay, last question. I just want to ask you about, we talk with retirees, talk a lot about things like cash wedges. Is there a spot within this portfolio on obviously the defensive side to look at like a cash wedge?
I always like to have a little bit of cash. And so it's going to be a function for, in particular, a retiree. You likely want to have some maturing, whether it's T-bills or some sort of T-bill, in particular for, call it, a 12-month period. I think that's just prudent budgeting. I'm not retired, so I keep fully invested. But I think that is a very prudent approach. And then, having a couple of years of layered cash flow as you're retired in some of the target dates, I think that makes a lot of sense. And then the residual on your portfolio, I'm a big believer, be invested. And one of the hardest things as an investor to do is be invested.
Emotionally, yes.
Yes.
All right. So thank you so much for walking us through the barbell portfolio, Paul. Just a quick reminder to our viewers, this episode will actually be available on demand in the Learning Center on Webroker and on TD Direct Investing's YouTube channel. Before we continue, just a reminder to follow TD Direct Investing on social media. Scan the QR codes that are on the screen right now to check us out on YouTube, Instagram, and Facebook. We have sneak peeks at our upcoming episodes of our live shows. We have video lessons to help you level up your investing skills and a ton of other fun content you're sure to enjoy. Our live viewer Q&A is coming up in just a few minutes, so get your questions in. But first, I want to bring in my colleague, Brian Rogers, to explain how investors can get started building a barbell portfolio on their own. Hello, Brian.
Hi, Caitlin. I didn't know you were so strong, just curling that 1,000 pounds like it was nothing.
I mean, it's clearly a secret talent I have hidden from everyone until right now. Brian, thank you so much for being on the show today. I want you to help me here by showing what tools do we have to help investors find investments from those specific sectors or industries that they might want to add to build their barbell?
Yeah, no, I would gladly like to show that, Caitlin, just because it's one of those things, there's so much information out there, and there's so many different places you can look. I want to show a few. There's three I've got in mind, three easy ways you can do this on the Webroker platform. So if we jump over to Webroker really quickly, you can see if you start off on the research tab, that's really the place you want to go initially. And you're going to see right away, you're going to see there's a section with indices and sectors and industries and news and so on. Obviously, we're looking at something in the different sectors that are available. So if you click on that right off the bat, you're going to get taken to a tab that says sectors. And immediately you can see there's a Canadian and US flag here too. So depending on if you're looking for US or Canadian stocks, you can change between, like it's going to change the information that's available. So if you just click at the very top between these little flag symbols. So let's say if you are looking at the US, you can see on here there's top sectors. It'll give you some top sectors on the right hand side. And then you can look at bottom sectors. They're already sorted for you. You can scroll down, you can see there's top industries as well. And then you can actually, on the very left-hand side, you can see sector performance, which this is something that you can sort that I really love, that you can go by earnings per share growth. If you want to click on this, it's going to sort it from highest to lowest. And every single one of these is a hyperlink that you can utilize. So if you wanted to click on, I don't think it's any big surprise, that just even from your conversation, like technology has been pretty high recently. But if you wanted to click on that and see what are the industries that are in there, and maybe an industry catches your eye, like semiconductors as an example. So now this is going to list all of the stocks available, which you can sort even further from there. So that being said, just remember you do have the under the research tab, there's sectors and industries. I'm just going back there really quickly. There's even a graphical thing you can use as well to see by all of these different measures, like where the different sectors are at the moment, and then you can click on those as well. The other second one I wanted to show, Caitlin, is under indices. You go to indices and you can click on any of these indices, like the S&P 500, for example, in the US is a popular one. If I click on the members, this is going to show me all of the stocks that are listed in this index. And you can now sort it by dividends, for example. If you're looking on that barbell to get more safety or get more income, you can sort this by dividends. And then you do have this drop down that's also even going to allow you to look for things like Canadian dividend aristocrats or a number of different sectors that are available. So the last one, really quickly, because I could go on about this forever, Caitlin. There's so many ways to find sectors. But the last one is just in the screeners tab. If you go into research and then under screeners, really quickly, just to show that you can screen for stocks and ETFs as well. But if you're going to screen for stocks as an example, you can click on screening right here. And then you're going to, usually what you want to do is click on this bulk edit and then go to more criteria. And now you could go to sector and industry, add that in, and you can choose between, there's 11 sectors altogether and 55 different industries that are in here. If I clear this out and I wanted to go for like consumer cyclical as an example, now I can choose between what industries in there. But if it's a sector I'm looking to add to my portfolio, you're going to have that information available, and it's going to spit out the stocks or the investments that are in that particular category.
And that's why we have you on, Brian. You're a wealth of knowledge, giving us all that information. One other quick question. So somebody's done that research. They found a couple maybe different investments they want to keep an eye on. They're not ready to add it to their portfolio. Is there any way for them to kind of try that out before purchasing?
Yeah. And this is one of those things I loved when I first started investing is you can do like a mock portfolio, like a paper trading in a way. And, within the watch list within WebBroker, you can do just that, Caitlin. So if you identify some of those stocks and you don't want to you don't want to jump in the pool, you want to maybe dip your toe in the water, or maybe not even purchase those yet, just to watch them on a watch list, we can do that. And you can actually even put in a price to see, how it would have done if you did buy those particular stocks or create that portfolio. So if we jump back into WebBroker quickly for a moment here, we can see on the right-hand side, we have watch lists. I've already created a couple already, and I even put them as barbells just as an example. So if we had like a barbell stock portfolio, what I did was I put in a number of stocks, and these are just random, so this isn't any advice or anything, but random stocks that might be in different sectors like technology, and we have consumer, and what else? We have some, energy and things like that. So US and Canadian. But what I did is on this tracker tab, after I've added these stocks, there's a tracker tab where I can enter in a number like a quantity and then an average cost, so a cost that I bought them at. I did this as if we were purchasing these about a year ago today. And you can see it's pretty cool. Now I can see I would have been up around 37% on that portfolio, just with about a $50,000 portfolio roughly. So you can do that. I did that with stocks, and I did another one with ETFs. It's a little bit lower in terms of the gain because it's much more diversified. But you can see if I had done something similar with a number of Canadian and US ETFs, I would have had about a 17% increase over the last year anyway.
Very good. Always important to have a way to sort of test out those ideas before you pop in. So thank you so much, Brian. Really appreciate you showing us that. That was Brian. Brian is a TD Senior client education instructor, same title as me, and I can't seem to say it this moment. Brian Rogers, thanks so much. Just a reminder to our viewers, if you want to see more of Brian or the rest of our instructor team, including yours truly, check out our daily free live workshops. We cover everything from our platforms and tools to more advanced strategies. Scan the QR code that's on the screen right now to see a full list of our upcoming events. All right. Let's open the floor and take some questions from our viewers. Our first question that we have is from Manny. And Manny wants to know, with covered call ETFs, how do you mitigate the risks of net asset value erosion and capped upside?
So very complicated question, but one of those ways is to ensure that you're generating the requisite cash flow. And so, no, there is a risk. If you're writing 100% on a stock or on a portfolio, then unequivocally there is really no way to avoid that NAV erosion. And so I think that is one of the things to consider, is how much is somebody writing on that particular portfolio. And so for us, we've kept it at generally 33, some are up to 50%. So making sure that if you don't want that NAV erosion, then making sure that the right levels are appropriate, but that the cash flow can be generated from the option premium. In some cases, we've seen very, very high distributions. We've got a lot of funds. We know what can and can't be made, and so being cognizant of perhaps those that are not able to generate sufficient cash flow. In our world, we have funds that we run that are 20, 30 stocks that we we basically write the options to generate the monthly fixed cash flow, pardon me, versus our high income shares where it tends to be variable. And that way, that should help avoid any risks from our side of saying, okay, well, we're paying out more than what we're actually generating on the cash flow. So that would be number one for me. Capped upside, unfortunately, that's a trade-off. That's the trade-off of the high distribution, is foregoing some of the upside. Again, if you have something that's 100% right, you're going to have 0% of the upside or very marginal amount based on how far out of the money. So how much are you willing to balance out the cash flow versus capped upside? That's for an individual to determine. For our funds, we end up having a third to 50%.
Can't do cardio and strength at the same time. Sorry, had to go back into a workout. So doing your research, essentially, you want to make sure you understand the fund. Okay. Good. We have another question. This one's from Mohammed, and Mohammed's asking, most covered call ETFs don't outperform their underlying indices because the upside is capped. So how is that a good ETF strategy? Okay, so interesting. This is what you were just talking about, that whole cap side.
Well, I think there's a couple things in there. And so somebody says, well, you should just buy low cost beta and just buy the market. And I'm like, well, if that's true, then why didn't you just buy the NASDAQ? Because the NASDAQ's outperformed the S&P, or why haven't you bought the MSCI? And so I would say most is an overstatement on covered calls. It is a function of what asset class and the time horizon, and you go back to the 2000 to 2010, many of and if not most of covered calls outperformed. So it's different times, different time frames on different benchmarks. But I would caveat that by sometimes people don't just want beta. Sometimes people do want the bird in the hand cash flow. Mm-hmm. And that's, for me, do I want to be invested in this particular asset class? Or is this the portfolio that I want? Am I okay to give up some of the upside for some bird in the hand cash flow each month? That's the way we view the world.
Okay, very good. Amy has a question for us as well. Amy is saying, with 150K in cash, could covered call ETFs be a suitable alternative to GICs? Ooh, interesting. Also, how are the income and capital gains from covered call ETFs taxed in Canada? So big two-parter there. First one, comparison of, so it's kind of what I was saying a little bit there, that whole idea of the fixed income side of things. It's interesting how there are kind of some of those correlations between covered calls and fixed income, really. So yeah. Take it away.
So unequivocally, no, it is not an alternative to a GIC. You are taking market risk, and so you have to be comfortable with market risk. If this is something that you need certainty of this cash, then look at GICs or something that is, we talked about that, whether it's a cash alternative or something that is perhaps a laddered, that has a fixed termination date on the fixed income. So definitely, and not all covered calls. It's kind of like saying, oh, I'm going to buy stocks. In covered call strategies, there's lots of different strategies. Our high income share, HHIS, is high growth and tends to be very volatile. We have our HRIF, which is a more, 125 underlying stocks, a little bit more market-like, if you will. And so be cognizant of, one GIC, no, is not the same as covered calls. You're taking market risk. Taxed in Canada, options are taxed on capital account, which means typically taxed very favorably. We tell people generally, you'll still have some dividends if it's Canadians, underlying stocks, you'll have some foreign income if it's foreign stocks, but the options are taxed on capital, which means typically capital gain, asterisks. You can check out our website. There's a whole section on tax because tax is complicated, and so, but typically very tax efficient cash flow.
And I know we have a video on our website as well. If you're looking for more information about taxing of options, I know we have one on our YouTube page. You can check that out. No, it's gone. Okay, we have another question coming in. This one's from Raymond. Raymond's asking, can you talk about the downsides or any red flags of factor index ETFs that investors should be aware of compared to traditional indexed ETFs?
Ooh, that's loaded. I would have to know which factor we're looking at. And so, I think if I'm not mistaken on Raymond's question, when we think about your traditional growth value, I guess factors is what we're talking about.
Can you just clarify what you mean by that?
So you're kind of looking at, in the growth, you're looking at stocks that have higher growth rates than the average,
okay.
And your value tends to be inexpensive stocks that are trading cheaply. Mm-hmm. And those are diamonds in the rough, or, I'm going to buy this stock because it's really cheap. And both of those have merits. Now, there's also all kinds of other factors now that, it's no longer your traditional fama French, as one might call it. There is all kinds of, whether it's momentum, whether it's, deep value. There's all kinds of different factor ETFs that are out there. I would say being overly exposed to any one factor, dividend factor is another one. So, dividend growth. So, being overly exposed to one factor in a mandate, I think, is something to give consideration for. It doesn't mean that, just because it's a dividend focused fund, that it's overexposed just to that one slice factor. We've got a dividend fund that has 30 stocks. It's still very much a large cap, fund that's well diversified. Mm-hmm. But anything, when I think about maybe the red flag, is more so on the momentum side. What type of names might be in a momentum factor fund right now. So that would be the one flag I would look at, or at least give consideration for.
Okay, so they're essentially just like specialty type funds, something that has a specific focus outside of just being U.S. equities.
That's
kind
correct,
of thing.
yes.
Yeah, okay, perfect. Paul, thank you so much for helping explain more about the barbell strategy, getting our workout in this afternoon on this lovely Thursday afternoon. So those in our audience, thank you so much for tuning in. Make sure to check out next week's episode. Many Canadians think that they'll need over $1 million to live comfortably in retirement, but we'll speak with an early retiree who says he's living a fulfilling retirement on just $500K. We'll hear how he's making it happen. That is all the time that we have for this edition. From everyone here at Inside Investing, thanks again for watching, and we'll see you next time.